Morning, Jennifer. Morning, Alistair. Morning, Margaret.
Morning.
Morning, everybody.
Morning.
Morning, everybody.
Morning, Princess.
Thanks for joining. Morning, Peter. The two Peters, Peter C, Peter B. And morning, Thomas. If you've just joined in typical playpen fashion, if you could mute, please, just to cut out any background noise, that'd be great. Yeah, morning, Mark. Thanks for joining. You could mute once joining, that'd be great. Thank you. And here we go. Morning, Charles. Morning, JQ. Margaret, if you could mute, that'd be great as well. Yeah. Oh, there's feedback coming already. Hang on. Who's that? That might be Charles. Yeah, this session is being recorded. We'll come on to that in a minute. Mark, thanks for the question. And let's bring John in as well. Morning, John. As I say, if you've just joined, if you could mute, please, that would be great. Actually, Margaret, I'll mute you because I think I've got that power to do that. There we go. That's easy. That cuts out any background noise. Okay. Right, excellent. I think we're there, which is good. First of all, welcome everybody to this week's Pension Playpen Coffee Morning. Delighted to have Sarah Abraham from First Actuarial presenting, ably assisted by Henry Tapper. As usual, this session's being recorded, so can we have a thumbs up from everybody that everybody's happy to be recorded? If you'd like to ask questions towards the end, that'd be great as usual. Henry and I will also monitor the chat as well. If you want to make any comments in the chat, we can then bring you in and we can open up the floor for debate and questions. I've just brought Bryn in. Morning, Bryn. If you could mute, please, that'd be good. And Clive. So morning, Clive, if you could mute. So good. Okay, right, we are recording. Henry, over to you, and we'll start the session.
Thanks, Steve. I worked at First Actuarial for 10 happy years, and during that time I was sued twice by people who wanted to shut me up when I was shouting from the rooftops, be careful about this CETV transfer business. It could end in a bad place. And as people know, I spent quite a lot of time down in Port Talbot and other places trying to help out the predicament of steelworkers who were sleepwalking into pension pots and away from a good quality defined benefit pension scheme. So that's a little bit of background. We're very keen to see advisors being protected from not just from the FCA, but from themselves when they make mistakes, and to ensure that they don't find their businesses ruined by the decisions which they've taken in the past. And pleased to see that First Actuarial are helping advisors to sort the sort of problems that they've had in the past out. But I'm not going to prejudge anything that Sarah has to say, just to say, very pleased she's come on to talk about this difficult subject this morning, and look forward to hearing what she has to say. So over to you, Sarah. Thanks very much for coming.
Thank you, Henry. Hello, everyone. Normally when I speak at these events, I'm talking to IFAs and compliance consultants only. So if I start going off into terminology that you find confusing, just nudge me and tell me to explain myself in sort of a normal pension speak. I run the pensions redress team at First Actuarial, and I've been working in pensions redress for about 5-6 years now, having previously worked in kind of what I'd say was mainstream pensions. I'd say, and just alluding to what Henry's just said, I think when I first started working in pensions redress, it was quite eye-opening for me, having come from a place where things were quite regulated and everything was quite robust, coming into a world where, frankly, there was some bad practice. The FCA has taken steps to try and address some of that bad practice. But as a consequence of that, I became quite passionate about talking about redress, about raising awareness of the risk associated with defined benefit transfer advice. And I suppose what I'm aiming to do today is to talk a little bit about those topics in the context of the FCA's new proposals. I think I'll just start by explaining what I do day to day, so that we're all clear about what I mean when I say redress, so we don't get confused. So what First Actuarial are doing, mostly for IFA firms. We do sometimes work for people on the other side, so claims managers and lawyers representing consumers. Is we will calculate the recompense or the redress that is due to people who've received advice to transfer out that was deemed to be unsuitable, which means not right. It's kind of a polite way of saying not right. And we'll do that for people who've transferred out of occupational defined benefit schemes, but also people who've transferred out of defined contribution schemes, because that sometimes happens as well. So I was going to start by kind of facing into our nuclear bomb. Oh, hang on, just make this work. Facing into our nuclear bomb. And then what I'll do is I'll talk a bit about the risk, and then we'll come back to more details on the FCA's proposals. So yeah, so the nuclear bomb. I think the FCA has proposed in its consultation paper in November that personal investment firms, so that's firms that have given financial advice to individuals, on investment products, set aside capital for potential redress liabilities. So what that means is that firms who've written all sorts of advice, it's not just pensions transfer advice, will need to work out where they might have to pay redress in future, and they will need to set aside capital for that. And if they then find that they haven't got enough capital, they're undercapitalised, there will be asset retention requirements put in place on them. And that means that they can only use the firm's money for certain activities that the FCA consider to be in the course of kind of everyday business. And we've seen those asset retentions put in place before, particularly in relation to firms that advised on British Steel. They can be disruptive to firms' operations. So, I speak to people who are trying to retire and aren't able to sell their business because of these requirements. It can create difficulties. So, effectively, the FCA has come out with these proposals, and I think it has shone a light on pensions transfer in particular. Pensions transfers kind of getting attention here because we know that the FCA isn't massively keen on defined benefit pensions transfer. Their starting point tends to be people shouldn't be transferring out, and people are better off in their defined benefit scheme. And secondly, we know that pensions transfer, both DB and DC, defined benefit and defined contribution transfers, can result in quite high redress payments. And thus, if you're having to hold reserves, you're more likely to hold more if you've written defined benefit transfer advice in particular. So it shone a light on pensions transfer as a kind of risky activity, and it's PIFs that have written pensions transfer advice that I think are most alarmed by this consultation paper. That said, the FCA, when they talk about it, their view is, you attend, they've been doing some webinars and in-face sessions about this, and they're very much of the view that their proposals are only drawing on what's already there under Consumer Duty. So Consumer Duty came into effect sort of last year-ish. But under Consumer Duty, firms are required to understand the risk that they're exposed to. They're required to hold enough capital. They're required to deal with complaints and pay redress in a timely manner. So when the FCA talk about this, their stance is almost, this is just formalising what's already required. We don't think many firms are actually going to be hit by asset retention rules. We see this as just an extension of good practice. It is almost the tone you get. So, if you talk about that nuclear bomb, I think some people are saying there is a bomb in my garden. The FCA are kind of saying it's not that big a deal. And I think what I would like to explore in this session is the extent of that risk and the extent of that bomb, and then you can draw your own conclusions on whether you think it really is an issue or not. The FCA, alongside the polluter pays proposals, as they're known, is looking at a wider review of the regulatory regime for these firms, and I think in some ways that bit is that the direction of travel is certainly more capital being required for personal investment firms, and they've also mooted that firms that have written high risk advice, of which pensions transfer advice is one, and more generally advice around personal pensions and SIPs, firms would have to hold more capital and potentially liquid capital as well, so not, you know, liquid assets in relation to that advice. So in my mind, there's a direction of travel there, quite aside from the polluter pays proposals. There's a direction of travel which is, if you've written defined benefit transfer advice, you need to be preparing yourself to potentially be holding, you know, more capital in relation to that. And I think that's definitely worth being aware of. And you know, irrespective of where we go with the polluter pays proposals. I'll just start by sort of explaining how pensions transfer redress is calculated. So I mean, the crux of it is what you're doing is you're comparing the pension that someone has now to the pension they would have had they not transferred out. So the objective of redress is to put the consumer in the same position they would have been had they not transferred out. So if you picture a defined contribution pension, I think that's reasonably easy to get your head around. So let's say Mrs. Smith had a pension with Royal London. She transfers it out to a, you know, illiquid property in Spain. The illiquid property in Spain loses all its value, so it's now not worth anything. The amount that she needs to be given back is basically the value of that Royal London pot that she transferred with some interest. And I use that as an example because I do see quite, you know, it is quite common to see cases where people have been advised to put their defined contribution pension in something of that ilk that is not suitable, and you do see big redress in that situation. And actually, I suspect that, you know, a fair amount of the compensation that's been paid by the Financial Services Compensation Scheme in relation to pensions transfer is in relation to these unsuitable defined contribution transfers. Whereas they don't get as much attention. They are out there, those cases. So that's how you would do a pension, you know, a transfer loss calculation. Now, obviously, for defined benefit pensions, it's a little bit more complicated because you've got to put a value on a defined benefit pension. And what that means is you need an actuarial methodology and you need actuarial assumptions. And so the FCA's worked very hard to come out with what it thinks is a fair set of assumptions and a fair methodology. It did that through, well, there was guidance in place prior to last year, but all of the redress rules and sort of the way the assumptions are set and the methodology was revised and firmed up, let's say, as part of the review of the redress rules, which came into effect last April. So there's now actually a very prescribed methodology for dealing with redress calculations and valuing that defined benefit pension. And the assumptions are heavily prescribed as well. So if you do come up against a redress calculation, there's no real flexibility there on how you calculate the value of that pension. And then you compare that value, which is based on these actuarial assumptions, to the value of the pension that you got now. So for example, the personal pension that someone's transferred into. If they've taken money out, let's say they've used £50,000 to buy, you know, to spend on a trip around the world, you can put that money back into this. They've had that benefit from it, so that can be allowed for in the calculation. That makes sense. It can become quite complicated and subjective if let's say somebody transferred out a while ago and they've consolidated different transfers. You know, defined contribution transfer from here and a defined benefit from here and another defined and you've got to try and unravel that current pot between the different sources. That can become quite complicated. And actually, under the new redress rules, you need to use an actuary or a methodology approved by an actuary to do these calculations. Whereas in the past, firms sometimes had a bit of a stab themselves. Which, you know, when I talk about bad practice, it was not necessarily intentional. It was just an attempt by people to save money by trying to do something themselves, which was very complicated. But the new rules don't, you know, they're not really for the faint-hearted. They read as a kind of actuarial manual. So if you are lucky enough to look at them, just, you know, be warned, it's not easy going. So, you know, in terms of defined benefit transfer advice, what is the risk for an IFA who's written that advice when they think about their redress exposure? Well, first of all, because the value of the pension is set using prescribed assumptions, it's very sensitive to market conditions. Now, the FCA's basis is basically assumes that the consumer will invest in growth assets in a kind of will obtain a prudent return, say, on growth assets until they reach retirement, and they will then purchase an annuity. That's the fundamental principle beneath the assumptions. And for that reason, it becomes very, the value of that pension becomes very sensitive to the price of annuities, effectively. I can see a question from Rob, and yeah, well, I'll come back to that, Rob, but I think it's a very good question. In terms of, so that's one risk, you know, it's very, very sensitive to market conditions. The other one is that the value of the transfer proceeds is very sensitive to how the investor chooses to invest that money. Now, I had a case where there was a man, he transferred out and he'd taken some of the proceeds of his transfer, about £80,000, and he invested it in direct equity, you know, in just one stock, and lost £20,000 in 2 weeks. And when the redress was calculated, the IFA had to pay compensation for that. He had to meet that cost. Now, you know, from the FCA's perspective, they would say that person shouldn't have been put in a position where he could make that not very good investment decision. But ultimately, it does mean that if you're an IFA and you're no longer, particularly if you're no longer working with that customer, which you might not be, you are very exposed to people not doing the optimal thing with their money. So that is another area of risk. I've got a couple of graphs here to kind of explore that. So this is a graph that shows the movement in typical redress. Now, this is for people who've transferred out since the introduction of pensions freedoms. It's very indicative, and it's showing a sort of direction of travel. Actual redress per person will depend very much on that individual circumstances. But what you can see is that redress has fallen by about 80% over the last 2 years. And just to put that in context, that's the period over which from the point that the FCA identified that they needed to review the redress guidance and put in place some more formal rules, formulated and implemented the British Steel Consumer Redress Scheme. All of that has happened in that period since redress kind of peaked. So it's been bad timing for, you know, we can talk about British Steel, I'm sure, if we need to, but it's been bad timing for the FCA from that perspective, because everything they put in place was based on a much higher level of redress. And then obviously gilt yield rises and annuity price falling has really kind of pushed down redress. So that's sort of showing you how, you know, it's really important to understand that redress is the difference between two big numbers, and a really small change in one of those numbers will massively swing the answer, the redress answer. So I think, you know, if you look at where we are now, it looks like redress has fallen back down to where it was. So that bottom dot to where it was in October, you know, it seems to have improved a little bit, sort of dropped a little bit again. So maybe it will just bounce around, but it is very sensitive to market conditions. And this graph here, which hopefully you can see okay, shows, I've just plotted on 1st of April, it's a dummy result, but that shows what would happen if there was a 1% fall in government bond yields between the end of the last year and April. And you can see redress is more than doubling. It's going from about 25,000 to about 60,000. So very, very sensitive. And I have done modelling to look at the impact of a 25% fall in equity, and you get the same kind of impact, a doubling of redress. So it is very, very sensitive. And just to look at the impact of investment strategy. So this is again a completely made up scenario, but somebody transferred out in January 16 and has invested in UK equity since then. I've just forced this to give me a redress figure so that we can see it, of 65,000. If that person had instead invested their transfer proceeds in global equity, they'd have no redress now. So, you know, because global equities perform much better over that period. But if they'd invested in bonds, £140,000 redress. So you can see the swings there from the different investment strategies. I've done, you know, I think it's well publicised that a lot of British Steel consumers are not receiving redress. The one I've seen where somebody receives substantial redress, the advisor had tried to do the right thing, had invested them into gilts, into government bonds, and that one had quite high redress because of the way they'd been invested. You know, similarly, I did one a couple of weeks ago where it was, you know, eye-wateringly high redress because the consumer had been put into these safer assets. Safer assets. So it is really sensitive. So, you know, I guess I am coming to your point, Rob. I think if I'm being absolutely blunt, I think there is a bomb here. I'm not sure the bomb is the FCA's bomb. I think there is a risk, and I think there is a need for, as Henry was alluding to, IFAs to understand that risk and take it seriously, in order that the whole of the regime works. Because if you're a trustee and you want people, you're allowing people to transfer out of your scheme, you need to know that there's a functioning compensation process if that advice turns out not to be right. That's why we require people to take financial advice to some extent, is so that they are protected. So I think there's a bomb there. I think the FCA's proposals are shining a light on that to some extent. And so many questions distracting me, and so many exciting questions. I think what typically happens is that this light comes to risk when firms are looking to either sell their business. They'll start thinking about it because they'll want to get on the front foot and have an understanding of what the risk is there before the buyer asks. Or if you're buying a firm, you want to do your due diligence. I believe that when Quilter bought Lighthouse, the due diligence was not that strong, and I don't think that was particularly helpful for them. So if you're buying a firm that's written defined benefit transfer advice, you really want to be making sure what you're buying and what's in there. But I think a lot of firms will say, well, fair enough. Some firms haven't written very much advice, or will have really comprehensive PI cover, and that's fine. A lot of firms will say, but my advice was really good. And it's not my job to assess suitability of advice. I don't do that. I leave that to people who are compliance experts. But what I would say is everybody I speak to thinks that their advice was right. And in most of those cases, I'm speaking to people who've had a complaint, and that complaint has been upheld by the Ombudsman or by the FCA. The hurdle for proving advice was suitable is high. It can go round in circles. You get situations where a firm reviews advice, finds it suitable. The FCA reviews advice, finds it suitable. FOS looks at it and says it's unsuitable. People can be going 3-4 years with reviews being carried out, looking at the quality of advice. So I think, particularly if advice was written a while ago, there could be gaps in the data, which can be a very common reason for advice being found unsuitable, even if it was probably the right advice. If you can't show the full data file, that can cause problems. So these are anecdotal observations that I have, rather than it being my area of expertise. But it seems to me that it's a high hurdle to prove that advice was suitable. The other thing that people will say is, just coming back to this graph, is, well, redress is really low now. Well, yeah, I mean, redress has fallen. It has fallen, and it is, let's say that the person hasn't invested in kind of bonds, so you're kind of ruling out the investment strategy piece. I think it is really important to note that this graph is showing typical redress for people who transferred out post pensions freedoms. Where people transferred out earlier, so let's say people who transferred out in the 90s, early 2000s, typically the transfer values that were being paid at that point were a bit less generous. And a less generous transfer value will result in higher redress. So you can still see very substantial redress payments, particularly in relation to legacy, sort of historic benefit, defined benefit transfer advice. It's not the case that there is no redress left. I deal with cases all the time, and people say, I'm assuming there isn't going to be any redress on this. Can you just do me a quick calculation to make sure? And I have to say, no, there is a substantial redress here. You need, consider whether you want to go for FOS and fight this harder, because it's not going to be nothing. So it isn't the case that redress has just gone. I'm just going to have a look at a few of these questions before we go on to the next bit. So Rob, yes, redress absolutely doesn't put and this is related to your question, your comment, Henry. Redress doesn't put people back in the position they were in, because they're not put back into the guaranteed environment. And I think there was a big hoo-ha about the form of redress payments as part of the FCA's review of the redress rules last year. So, well, kind of going back the last 18 months. Originally, the FCA had said, we think that people should have to top up their pension. So redress payment should have to be paid into someone's defined contribution pension. Now, that still doesn't put them back in the position they would have been in, obviously. I think a lot of advisors felt that was fairer, because they felt that people were just getting cash lump sums that they felt that people getting their cake and eating it effectively. You make a complaint, you get some cash in hand, but you've still got your nice defined contribution pension. I think what advisors would have liked to see is people being forced to annuitise with the money that they were, and you can see the logic there, because that is actually the closest to putting them back in the same position. So the FCA originally said, well, let's put it into the defined contribution pension. That kind of got pushed back because it just doesn't work from a kind of annual allowance perspective. And if the lifetime allowance did come back, it's not ideal to have people with more money in pensions if they, you know, if it's going to push them over the edge. So I think, and there's a lot of sort of tax complexities as well of trying to pay money into someone else's pension and how you get the tax rebate on that. So that kind of fell away. As I say, I think advisors would have liked to see people being forced to annuitise. The FCA, I think, can't really do that within the legal framework because they can't force a consumer to take an action with their compensation money. This has to be processed in the same way as any other compensation payment, as I understand it, and therefore all they can do is offer cash. I think under the law, it's very complicated, but it was certainly a big cause of discussion and discontent with the FCA's proposals. Rob, you're right. And as I say, it's directly tied to your point, Henry, because the only way that you wouldn't see that volatility is by putting people back into a defined benefit pension. Because if people were forced to invest in you know, forced to buy an annuity with a redress payment, you wouldn't have this situation now where some people feel that they've been over, you know, some Derek, who got his compensation last year, has got much more and I haven't got anything. You just both have an annuity. No, the IFA can't have the gain, Steve. Sadly not. If it's a no loss, it just moves on as a, yeah, you don't get to pocket anything.
That's wholly unfair, Sarah. You know that's wholly unfair.
Well, it is. I guess in, you know, in some cases people have taken all the money, haven't they? There's nothing left. So why is redress not in pensions form as per original saving? I think I've covered that, Margaret, but if you need any further commentary. Yes, and your point, Patrick, about investment decisions after the relationship severed. I have seen people contest a FOS decision and say, I don't want to be paying redress in relation to advice that was given by another advisor after this ex-client moved away from me. And that is a route you can argue with FOS. You can say, I think I should only be liable for, you know, I think what we should do is take the fund value of those transfer proceeds at the point that I stopped advising and then index it in line with an index, rather than allowing for actual performance after that point. And sometimes people are successful with that argument. And I don't know why sometimes they're successful and sometimes they're not, because I'm not FOS, but I know that some people are, because you're right, it is a bit difficult. Firms with DB, people do buy firms with DB transfer cases, but increasingly they will do a full redress exercise as part of the sale of the business. So we quite often pick up what we call a past business review, which was a wholesale review of all the advice given and a correction of any redress as part of the transaction. Now that's quite common. Right. Yours are quite complicated, John, right? So TV a million, promise benefits.
John, would it be helpful if you actually asked that question sort of in a spoken
go on,
way?
Ask me the question, go on, because then we can all rehear it together. Are you on mute?
You there, John?
I think you might be on mute.
Trying to work out where the mute button is.
Don't forget you can raise a hand and we can bring you in.
Yeah. Okay, John, if you can't get off mute.
Okay.
Do you want to have a stab at it?
I'll try and read it out. So it says, oh, can we bring John in?
He's struggling, eh?
Okay.
Yeah, he is unmuted, but you can't hear him. So
okay, so there's £1 million transfer value paid, a promised benefit of £25,000 per annum starting in 3 years' time. The sums are invested in 2 apartments with a yield of £25,000 per annum with a transfer value of £500,000. So essentially, redress would be measured against the market value of that asset, I think, unless you know, if it was down to me, I'd probably you'd be required under the redress rules to use the market value of the asset, not the future yield on it. But if it was going through, you could potentially argue with FOS about that, I guess, if you were the advisor. And then the redress would be, the difference between the value of the £25,000 pension and the market value, if that makes sense. So I think it's a fair point, which is that the way that redress is calculated is not necessarily the most intuitive thing in the world. And I think that's why IFAs do feel, they often feel very aggrieved. And you get people on the phone who don't have PI cover, and this is their retirement money. And people it can be very upsetting having those conversations. And I try not to take strong views on either side. I try to take people at their word. It's hard. So right, I'm going to go on with the presentation, and then I'll come back to some more of these comments, because otherwise we'll lose our flow. Right, so so I guess in terms of do I think there's a bomb? I think there is a bomb. I'm not sure it's the FCA's bomb. I think the FCA are kind of digging up and showing it to us, but I think it's there anyway, and I think firms do need to take this seriously. So just coming to a bit more detail on what they're suggesting. So as I say, firms will need to identify and quantify potential redress liabilities. And those will fall into the category of either unresolved, which means that they're complaints that have already been received and haven't yet been resolved, and prospective, which is a kind of rather nebulous concept that there may be something in the book that redress is due on in future. I think that's a much harder thing to define, and I think what we'll find is that different firms interpret that in different ways. Then you need to then you quantify the redress for that. You estimate how much you think redress might be, which is not easy, frankly. Then you apply a probability factor to reflect that not all claims will result in redress. So there is an uphold rate, and there's also a possibility that people won't complain, or it won't come to fruition. And then you set aside capital with this potential asset retention requirement. Now, I think the first thing I would say about this is there are exemptions in place. So exemptions for groups that are sort of have risk managed. If you're part of a group and you've got risk management happening at that group level, then you're exempt because it's falling under a different regime. There are also exemptions in place for sole traders and unlimited partnerships. But those exemptions are only from the formal asset retention requirement. So small firms will still be required to do this identification of their redress liabilities and quantifying them and reporting to the FCA about them, which is quite a lot of, it's quite a bit of work for them. If the FCA considers that they need to have an asset retention requirement, the FCA will put in something bespoke for them. So it's not the case really that sole traders and unlimited partnerships are free from this. They won't be. Potentially they will see an impact. That would be my first observation. The second observation is the 28% is a minimum unless you apply for so let's say we know that sometimes claims managers will take completely unmeritorious claims to the ombudsman, and let's say you've got one of them. You might be able to make a case to the FCA that actually it's not meritorious for this and this reason, so you want to use a 10% probability, and you might be able to get the FCA to agree to that. I think the bigger issue is, let's say you've never had a complaint and you put in 28%. 28% is the kind of, it's almost the default. But if you've actually had experience of having complaints being upheld, then you're meant to use the probability, you're meant to look at your own actual experience of cases of that type. So let's say you've put in 28% and you've started to hold capital based on the 28%. But a week later, you get a complaint upheld from the ombudsman. Suddenly, your uphold rate is now 100%. And I think, arguably, that probability factor then has to go from 28 to 100% immediately. I mean, again, it's probably one for a debate with the FCA about that probability factor. And you'd have to report, your firms are going to have to report to the FCA what they've used. But I think there's a high risk that 28% increases as you receive complaints, or if in the event that you receive complaints or you start to review cases. So that's something to watch for, and I think potentially quite unhelpful. And the third thing is that, quantifying redress, particularly in relation to defined benefit transfer, is extremely challenging. It's not at all easy to guess what redress might be on a given case, and I'll talk about some possible ways of doing that in a moment, but it's not easy. So, you know, if you are an IFA firm now and you're looking at this and thinking, what can I do? I think it's really important to understand redress. So this, you know, this goes a long way, you know, understanding what the factors are that impact on redress, how sensitive it is, how it can change. I think that's an important first step and actually I would say it's arguably under Consumer Duty firms should be doing that anyway. I think it's worth understanding your PI position. So as an example, some PI insurers will not cover cases where the advice was given to somebody who was under 55 at the point of the advice. So somebody who couldn't immediately retire at that point. And that's problematic because actually, if you have written advice to people who are under minimum retirement age, it's really, really hard to show that that's suitable. You know, that's an even higher hurdle. And so I think if you've got an exemption on that, that is a concern. You can also have limits of cover. So if a lot of advice has been written, you may find your PI insurer is only prepared to pay out a certain amount. And so if all your claims came to fruition, you'll just go over that limit. So that's worth being aware of as well. Gathering data, I've seen quite a lot of firms doing this, and I say it's usually at the point that they start thinking about selling. It's useful to know what you've written, the profile of the advice you've given. You know, how old were people? How big are those transfer values? What schemes were they coming from? Just so you've got a feel for your book. And also as part of that, you can look at the advice given and whether it was complying with your internal processes you have, because that understanding the likely suitability and how you would justify the suitability of your advice is quite important here as well. And then the other thing you can do, and I'm going to talk about this in a minute, is assessing the potential magnitude of redress and trying to understand really how exposed am I? You know, if you know, I was speaking to a lady and she's written a lot of advice to people, and sadly a lot of her clients are you know, are deceased, and you know that the redress on that situation is likely to be quite low because you know you get benefits tend to be quite high when paid to a defined contribution scheme on death. But you know, you need to, it's good to understand whether you've really got a lot of risk or not much risk, and really you're flailing around here for an order of magnitude, I think, rather than looking for an absolute understanding of what your redress might. There's no point in knowing it day to day because it can change tomorrow anyway, but just understanding, is this a massive issue, or actually is my book quite healthy and is this not so much of a concern? So in terms of kind of understanding what exposure you have, and I think this plays into both if the polluter pays proposals do take effect, these are options you could use to kind of fulfill that FCA requirement. But also you could just do them generally to understand what you've got there. So one option is to look at the excess. So typically your PI insurance will have an excess per case. So let's say you have a £5,000 excess per case or a 10,000 excess per case. You could just look at the number of potential cases that might be raised and multiply that by your £10,000. Now, as I say, if you've written a lot, you might be going over your limits of indemnity. So your limits of your cover might not be enough. You might have cases that are excluded, which you'd need to think about separately. And actually, you could overstate redress, because if your book's quite healthy, as we've seen, if redress is quite low, you might find that the redress is lower than that excess. So but it's an option, and that's obviously an easy, simple, quick thing to do. The consultation paper from the FCA very much guides people down a route of look at what we've paid in the past and kind of adjust it for the circumstances of your case. Which, I mean, you know, it sounds all right in theory, but in practice, how you would adjust that, I think, is difficult. At the very least, you need to adjust it for the date that you're paying redress. Because as we've seen, you know, there's no point in looking at what you paid in 2021 when redress was, you know, 5 times the size it is now. But you know, there are other things you could consider, like investment strategy, what scheme it came from, what date the transfer out took place. All of those things will materially impact on redress. So that's one option. Another one that people will often use is they'll look at the total transfer value that they've paid and multiply it by a percentage. So the going rate was always the British Steel 16%, which was the one you had to use for the first British Steel asset retention tests. I would say the British Steel percentage is not really the right one to use for most schemes, because British Steel's got very specific circumstances in that people couldn't because of what was happening at British Steel, you were either going to end up with PPF benefits or BSPS2 benefits, not British Steel benefits. So in theory, the redress is lower on British Steel than any other scheme would be, and that's partly what we're seeing come through. But that said, the 16% so old that it's actually probably quite high now. So, you know, the 16%, you know, people say they're using the 16%. I think, all right, you know, it's simple, it's easy to adopt. I'm not sure it actually is robust or meaningful, but it's something, and at least it's giving you a feel for how much advice you've written. So that's one option. The more robust options would be do an accurate calculation for every case. Now that might work if you've only got 3 or 4. You know, let's say you only really think you're going to get complaints in relation to a couple of cases which are already with FOS. You can do an indicative calculation, and an actuary could do that for you. Its redress calculations are dependent on data. So typically people will say, can you do me an indicative calculation? And I say, all right, have you got a fund value at the current date? And they say, nope, it's gone to another advisor. And I think, well, okay, I can do that indicative calculation, but it might be completely meaningless if we don't have a fund value, because we have no idea what's happened to that money in the last 4 years since you stopped advising them. So I question how meaningful that is. So I think this isn't worth doing unless you have at least data to make a reasonable stab at it. The other thing I just draw out is that if you estimate redress for a particular case and you find that you're seeing a loss, so not like Steve's case where he sees a nice big gain. But let's say you come out with a loss of £500,000. I think then if you actually start to try and look at the suitability there, was that advice right? It does fetter your judgment of that. It's quite hard, I think, once you know there's a big redress, to come to the conclusion that it's the right advice. Now, I know that in theory, those are completely separate things. But in my experience, firms say to me, I don't really want to be doing an individual redress calculation for every case, because I think it just muddies the water of that. One thing I did want to mention before actually is that sometimes PI insurers won't cover you if you trigger a suitability review yourself, rather than the complaint being received from the customer. Then sometimes the PI won't pay out. So if you start estimating redress and you decide, actually, look, there's a big redress here, and then you say to the PI insurer, look, we think we need to kind of trigger this as a redress case, they may say, we're not going to meet that because we weren't really on board with this. So I think you really need to be having conversations with PI insurers before you start trying to assess suitability of advice. Certainly, that would be a warning. And then the other option is to just do some approximate modelling in the whole book. So we will do this. So we can take sort of not full data, but high level data about the advice that's been written. So, you know, transfer value paid, amount of pension given up, and we can do a kind of rough redress calculation on a case by case basis, and then report back a total redress for the whole book, rather than identifying, you know, Mr. Smith it's this, and Mr. Brown it's this, and Mr. Collins it's this. It's just, we think your overall redress is going to be about, you know, 3 million. If market conditions change, you know, if equities move and investment performance is a bit less good, it might move to 2.5 million. So it can be incorporated with a little bit of sensitivity testing just to give a feel. So it's not accurate, and it's not intended to be accurate, but it's giving you an order of magnitude and allowing you to understand what is in your book and where your pockets might be of risk. So we can say, you know, there's a particular issue with transfers out of Rolls-Royce, because, you know, we know that the FCA is not very happy with them anyway, and actually the redress on those cases is quite big. So it can draw out some themes and help you understand your book better. So that was all I was really going to say about today, really, other than, you know, if you want to get in touch with me, I'm piece for FT Advisor on the polluter pays proposal, which has a bit more detail on some of this stuff around defined benefit pensions. And there's also a newsletter which you're all welcome to sign up for. I like people signing up for my newsletter, which you know, the February edition had some stuff on this as well. But there's other things, and you know, we'll have all sorts of different things on redress in different areas. So I'll take some more questions. So I can take the chat once, or we can do a bit of a chat. What do you think, Henry?
Well, Bryn, you've got your hand up. Do you want to ask a question to kick us off, and then we'll whiz round personal questions and go back to the chat at the end?
Yeah, thanks. It's a bit niche. I came into compensation for lost pension through industrial injury, industrial injuries, and sickness compensation claims. And there we just use the Ogden factors. Is there ever any discussion of why aren't they using the Ogden factors to value pensions for these purposes?
So Ogden factors are used sometimes when things go to court, but that does tend to be more based around loss of earnings. So I have seen them used for pension calculations alongside them being used for loss of earnings. I suspect that the redress methodology that we have now, because it is, to be honest, it's pretty robust and pretty tight in the way it's worded. I think it probably just works a bit better because the Ogden factors are a bit of a blunt tool for dealing with something that's quite sophisticated.
Yeah, well, that's the fault of the courts. That's what the courts do.
Yeah, and to be fair, I think with the courts, they're often looking for a settlement rather than an ultimate an actual redress payment, aren't they? So they're not expecting to actually pay out that exact amount. So I don't. It's perhaps not a question specifically for me, but I have seen them used.
Right.
Yeah.
Are you okay with that, Bryn?
Yeah.
Okay. Anyone else got their hand up or want to open up to the? I know, John, you've been quite vocal. I don't know if you can. That's John Matter. I'm getting my John mixed up. Was there a question you wanted to put, John? No, you're on mute. Okay. Steve Goddard, you've got your hand up.
Sorry, John. Sarah, sorry, John. Can we hear you, John? You go first if we can hear you. No, we can't hear you.
Can't hear you. Can't hear you.
Okay, that's fine. Yeah, Sarah, sorry. I mean, how long have you got, Sarah? I mean, I could talk about this for hours.
I know.
Well, no, just get to the point, Steve.
Get to the point. Yeah. The point is, do we not think I mean, obviously 50% of this population or this audience might feel this is fair and 50% might think it's unfair. But do you think the FCA have been a bit heavy-handed in all this? I've got a bee in my bonnet about all of this, which is, if you buy a pair of shoes from, Clark's, Prada, Chanel, wherever you buy your shoes from, Sarah, surely if they break, then you probably take it back after 6 months, maybe a year. Lots of practices like accountants and lawyers seem to have this sort of 6-year rule, blah 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 blah. Yeah. Why is it that IFAs sit here like lemons after phase 1 and phase 2 of the pensions review, which is 30 years ago, and are still responsible for advice given 30 years ago? Name me another industry, Sarah, where that happens. Why is that fair? Why is it fair on the PI industry as well? Because they're covering these IFAs who gave that advice. Yeah. Why is it fair that people suddenly, people don't wake up and say, "Oh, I must question my DB advice"? It's only driven by ambulance tracers, the press, and the FCA. Full stop. What are your thoughts?
Well, first of all, I'd say, the reason why it's not covered by the 6-year limitation is that people just don't, and they know this, people just don't think about their pensions until they reach retirement. And that's the problem. People just are a bit, we know that people just aren't very good at tracking their pension. And so when the time when you typically see people complaining, putting aside ambulance tracers, which I agree does exist, is when they reach retirement and they realise they haven't got enough, or they run out of money. I mean, you see people who've been doing income drawdown and there's just nothing left, and they're 63, and it's kind of bit. So I don't think it's the case that it is just, I see genuine cases of people losing a vast amount of money, really, demonstrably bad advice happening, so that it's not just ambulance chasers. But I do think it's perhaps tipped a little bit far one way, yes, because if you look at as I say, this hurdle's so high, FOS is so consumer focused, that it is just very difficult for the IFA to defend itself on its advice. And I think that is risky, because we know that some people do want to transfer out, and we know that these things do put people off giving this advice, and you need the advice to transfer out of a defined benefit scheme. So it just kind of breaks the whole system. I mean, actually, when I started doing this and I recruited somebody in to help me, and she'd come from an insurance background, She'd been a chief actuary at an insurance firm. She just said, I can't understand why people are even allowed to transfer out. Why is this even permitted? It just seems crazy. And you just think, well, I mean, because the insurance regime is so much more regulated. The idea for her, and then the idea that schemes would choose their own transfer value basis, she also found, absolutely astounding. How could that be allowed? So it's just, yeah, I mean, I think I can see it both ways, Steve. Do I think the FCA has gone too far with this? I don't. I think the FCA wants people to think about the risks they have, and I think that's right. I think the problem with these proposals is that they will be interpreted differently by different firms, and I think the good firms will end up holding, the capital and being really careful. I think firms that are just not that good just won't do it. I suspect is the risk here, because there will be firms that just don't, that always have been firms that just didn't take their obligations very seriously. And it feels to me like this is very much a self-reported compliance route. So that's an unsatisfactory situation, because you want to reward the good, not penalise them.
But then, yeah, sorry, Henry, just to finish up on that point, this other point about polluter pays, a lot of these, and JQ probably remember this from a lot of the work that he's done in the past, but, a lot of these were done on a fee basis. So let's say the fee was, 1,500 quid, 2.5 grand, or whatever it is. And so this audience needs to realize that, well, so the income may have been a one-off piece of income of 1,500 quid, 2,000 pounds, whatever it is. And the redress could be 100 grand negative or 100 grand positive, but the income is 1,500 to 2,000 pounds. So where does punishment fit the crime come out, and why are the IFAs guilty until proven innocent?
So a lot of the time, the motivation behind having people transfer is to get the assets under management. So people are wanting to bring the assets into their own arrangement, and then they're taking an advisor fee on that year on year. That's quite common. I think the key here is that if the advice is suitable, you don't have to pay redress. It's not that this is a certain thing. Really, what we all want is a robust regime where people give the right advice in the right place, at the right time, and to the right people. The difficulty is that you get this drag where we're now expected to have kept records and complied with current rules around a quality of advice, but actually if the advice was given in 2000, people they don't have the records. You see that all over pensions. You just see bad record keeping from the 2000s, don't you, or like the 90s. You get that with when you look at the quality of data in defined benefit pension schemes as well. There just isn't very good record keeping, and I think that's a real problem. But actually, if you're writing advice today, someone said to me, I'm writing advice today, do I need to start reserving for that immediately? And I said, well, I don't think you do. I don't think the FCA is expecting that, because the advice you're writing, you should be writing advice that you think's right, shouldn't you? Really, this should only really be picking up, Steve, people who have given poor advice.
I totally agree, but everybody gets sucked into the same arena. So
well, they certainly will if we end up with as I say, as I kind of mentioned at the beginning, I think this point around the wider regulatory review is perhaps more of a concern, because everybody does by definition get sucked into that. With the polluter pays, it's a lot more subjective as to whether you choose to let yourself get sucked in, because you can basically choose to say, I haven't got any liabilities. But I also question whether that's really, I'm just not sure that this polluter pays is really going to work in practice for that reason, because it is quite subjective. So maybe the FCA only has one route, which is to require higher reserves for firms that have written this advice. And then you're absolutely right, Steve, everyone does get dragged in. And the reason this was put in is because of the amounts that the Financial Services Compensation Scheme has had to pay in relation to redress that would otherwise have been met by PIFs. But actually, they've 95% of something was met by 75 firms. So you're talking about a small number of really bad firms creating a lot of problems that everyone else is drawn into, and I think that is a big challenge to it.
Do we have any idea, Sarah, of the likely impact of these proposals on IFA numbers, IFA capacity? Because we're all very concerned about the capacity crunch on advice.
Well, I mean, if you look at the FCA have done an impact assessment, which, as I say, they don't think it's that big a deal. They don't think it's that big a deal. So it's almost, you know, they're predicting a very small number of firms being impacted by asset retention. They're predicting a very low cost of compliance, which I think it's hard for me to see how. I don't think their cost of compliance really covers, it doesn't cover actuarial support, and they're specifically saying you don't need actuarial to support to estimate your redress, which I think is you know, fine. I'm not here to force people to take actuarial advice, but I think it's going to be hard for firms. And, you know, back to your point, Mark, about how do you understand how to measure your liability and revisiting it from time to time. That stuff's just, it's really hard for firms to do that, and they haven't factored in any actuarial costs. So they've got, you know, I think their impact assessment probably underplays the impact here, but that's the best we have, Henry, I'm afraid.
Okay, I know John's had his hand up, John Quinlivan. Do you want to ask a question, John Q?
Yeah, well, a comment really. I mean, the optionality for individuals with interest rate movements and volatility is quite extraordinary. I mean, the fact that, you know, we know what's happened in the past, that in theory could reverse in relation to long yields.
Yeah.
And as a result, that timing piece, and if we can have situations where there's absolutely decent advice, but the extreme movement in interest rates, driven by, as we know, government policy, as if it being the reverse, would have made people bankrupt. It's quite so. That's my concern. My biggest concern is, frankly, that the poor advice will potentially still continue, and good advisors will have to stick up incredible reserves. I think that when you've got such volatility with rates, I think the redress should not be of a capital amount. I think there should be two forms of redress. A capital amount of people want it, which is much lower. That's in the FCA's gift, and a stream. And that to me would solve some of this issue to do with rates changing, and that could, because people will be bankrupt on the back of that if the economics of a situation for good advice turned around on them.
Yeah. And
that isn't with the FCA's gift to say there's two amounts of redress, a capital amount which is lower. It's a bit like winning the lottery, isn't it? You know, you take a big lump sum, or you take an annual fee, an annual amount.
Yeah, it's worth consideration, because I think you know, if I was talking to a random actuary about this, right?
I'm a random actuary, by the way,
yeah,
so
okay,
you are talking to one.
Right. So for somebody who works in pensions but hasn't really seen this before, what I would say is effectively what you've got as an IFA is a completely mismatched defined benefit obligation here. You've got something that's swinging around, an asset base which is doing something completely different. You can't manage the risk. You've got no negotiation over that basis. And now what you're effectively being asked to do is to kind of fund for that upfront on a day-to-day basis. And that is kind of what's happening. And that is a risk, isn't it? It does pose a risk for IFAs.
It's not just the risk. I mean, I worked when I was at Aegon. I worked on the 5 for Life variable annuity stuff, and that's an equity, long yield mismatch hedge, delta hedge. It's a shocker. To actually manage that, it takes a hell of a piece of kit, and that's effectively where IFAs are with this now, which to me it just sends shivers down my spine.
Yeah.
Sorry. End of.
Yeah.
It's a great point. Unfortunately, I have to nip off, but please keep going, and thank you very much, Sarah. Sorry, I can't stay any longer.
No, thank you very much. I was gonna quickly cover off.
Sarah, do you want to let Henry leave and depart? But I'll take over. Do you want to just quickly look at the chat, Sarah? There's a few questions in there that might want to answer.
Mark's question is a good one about revisiting the redress given sensitivity to so many factors. You're absolutely right. The sensitivity to loads of factors here. So we've talked about that probability factor changing, could go from 28 to 100% overnight. That's quadrupling your cover. But actually, in terms of just estimating the redress, yes, you could track it looking at market conditions. If you've got new data coming available, so let's say you do finally get that fund value that you've been waiting for, that could affect your redress. Or you find out that the scheme actually has paid discretionary increases in line with inflationary discretionary increases in the last 5 years, so that needs to be factored into the redress calculation. So that could change your result. You could find that you're reaching the top of that cover of your limits of indemnity with your PI insurance. So if you've used the PI approach, you need to kind of be tracking what you're actually paying out against, you know, what you're assuming you can reserve for. So there's an awful lot of things there, as well as just the redress calculation itself being variable. But in terms of understanding the variability of redress to time, if you did use an approach where you've modelled the whole book, you could update that periodically. And that's a little bit, just going back to that analogy I was using with John, it's a little bit like doing a kind of, it's a bit like kind of tracking your defined benefit liability, sort of like a regular update of where you think your liabilities might be and where you think the value of that defined benefit pension might be. But realistically, you're always, and I was talking to this about with someone else, you're always chasing your tail because it's always retrospective. You're always looking at what might have happened in the last quarter. You don't know where you're going to be in future, and you've got no way of protecting yourself from that, really. And so to some extent, the FCA's proposals, whilst they may be well intentioned, putting aside some of the comments we've already heard, whether they will actually result in firms holding enough redress, I don't know. I don't know, because things could go wrong in that, you know, it can take 2 years for a case to be seen by FOS. So we have to be realistic about the timescales. It can take 2 years to get the data from an occupational scheme if you need to know, you know, what their early retirement factor was. It's not a quick process necessarily settling these calculations.
Yep. Okay. Are there any other comments that you'd like to comment on before we finish? It's a shame John can't mute because he's got some good comments there. And Billy, you said thanks, brilliant, Sarah. I totally agree with that. So that's fantastic. Small IFA will be finished. Do you agree or disagree, Sarah, with that? Maybe it's the last comment.
I think it could be painful for small IFAs because I think the governance is going to be tough. And as I say, because the exemptions are they're not as all-encompassing as you might read from the initial kind of quick speed read of the intro. I think it could be quite tough for small IFAs, yeah. But again, it will depend on whether they just take the view that they haven't got any potential redress liabilities. So again, it does come down to their own judgment, and depends how much how much resource does the FCA really have to scrutinise what everyone's put in. I don't know. I bet not that much. And just as a final comment, actually, you know, the FCA is now looking at retirement income advice, and some of these comments around the nature of redress in relation to defined benefit transfer will also be similar for sort of annuity purchase versus income drawdown advice that was given. So hopefully, you know, redress is low now, but there are similarities there, and that's another one that, because it's on their radar, do we take that as any retirement income advice is sort of high risk? I mean, who knows? So I think it is a worry. Sorry, there's so many comments here. Are there anything you pick up, Steve?
The only person I wanted to ask probably is Padraig. Padraig, you said a lot of things. Is there anything you particularly want to say to Sarah, or just say to the audience? Do you want to unmute, Padraig, and just say what you feel?
There was one point Sarah made about PI insurers perhaps not backing their insured if they advise somebody before the age of 55 about something they may do afterwards. Well, that's just ridiculous. It flies in the face of everything the government's done in terms of giving greater freedoms to the individual consumer. Now, I've been advised on things I might do after the age of 55, 60, 65, because they have to be planned for. I may have to pay for them differently, and that might be a choice to stay on working longer than I might have chosen to before. So to suggest that the FCA's actions may influence PI insurers to withdraw cover from providing advice on what might be done after a certain date is frankly ridiculous. If that would happen, I would love to see. Then you'd have to see IFA companies just coming together and maybe do a class action against the FCA, because frankly, their business would be ended. It's just an absolute nonsense.
So where those exemptions might apply is where, let's say you've advised someone who's 45 to transfer out of their pension scheme, and indeed that is, you know, a lot of, let's put British Steel.
That's already, sorry, but that's already not going to be right, is it? You're advising to transfer out. It's not going to be possible.
You can transfer out at any age. You can't. So where you're telling someone to transfer out and they can retire immediately, sometimes you can use as the justification for that transfer, you wanted flexibility in retirement, and that can help you get over that hurdle of, yes, this was the right advice. But the difficulty if someone is 45 and transferring out is you can't use that argument. So the FCA would say, well, why transfer out now at 45? Why not wait till you're 55 if you want that flexibility? There was no justification for transferring out at 45, and you know, a lot of the British Steel cases, actually people were young.
Yeah.
And
Okay. I take that.
very much
Going back to British Steel, but
Yeah.
it keeps getting conflated because it's a bad example. It's a great example of bad advice. Okay, but because it's happened, everybody then points the finger and say, "Oh, you're an advisor on DB schemes. You must be well dodgy." I know you're an advisor because I can hear your spurs coming down the thing. I know one example of an IFA, someone I've known for actually more than 40 years before he was even an advisor. FCA went for him in a big way a couple of years ago, trying to gut. He's never had any complaints against him. He does DB transfers. He hasn't done one for me. But they tried to crawl over him because of stuff. But he had independent actuarial reports. He had everything lined up exactly, not only as FCA might expect, but he went above and beyond because he wanted to protect his own backside. And yeah, I think it's a bit of a pincer movement with TPR. They both want to see the bottom end of the market, the smaller size rather of the market, cleared out so they can have a simpler regulatory regime. And it's just not. I just don't think it's good enough. Just because a company is not necessarily large in number doesn't mean it doesn't do a decent job. Just they can't be asked to properly regulate it. And that is, I sound like a broken record, but unfortunately, it keeps coming up with these regulators. They consistently do a poor job of what they're expected to do, and then they come to the market with a big stick and start spilling blood to show that they've actually done something to protect consumers. And yet they fail to regulate day in, day out the rest of the time. Sorry, I'll get off my soapbox now and hand back to you.
Well, also, Sarah, just to finish that point, Armageddon would be if the FCA push too hard, you'll see the PI insurers walk. They will just turn their back on the market. And without PI cover, the whole market is stuffed, big and small.
Specifically refer to PI insurers in this consultation, I think, for that reason. I can see your point, Simon, about language and wording. Yes, so sorry if as I say, I don't do review of advice. It's not my bag. So sorry if I've got the wording wrong, but I'm sure your point's very, very strong.
Thank you.
Cool. Okay. Well, listen, we slightly overrun. It's a very passionate, emotional subject for many people. Really appreciate your presentation, Sarah. Hopefully lots of clapping from the audience. There you go. Billy's clapping. There we go. Margaret's clapping.
Very nice to see you all.
So, which is good. Thomas has put his hand up. That's a brilliant session. The video of today will be up on Playpen later this afternoon. So if you would like to see that and you're a Playpen member, you should be able to view that. If you're not a Playpen member, please join. We really thank you for attending today's session, which was fantastic. And let's see if we can take it to the next level, and maybe a few journalists like Bodreg and a few other Sonia was on today might have an attack on the FCA. You never know. No, brilliant, absolutely fantastic. Thank you very much indeed, Sarah. Really appreciate that. And as usual, we want to pray for peace in the East and peace in the Middle East, and we hope things can be negotiated there. And next week we might be talking about another FCA project, but watch out for announcements on that. And I think Tom McPhail might be up for chairing a panel on that. So there we go. Sarah, thank you very much again from me and from everybody here. And everybody enjoy the rest of your day and the rest of your week, and look forward to seeing you at the next Playpen event. So thanks very much indeed, Sarah. Fantastic. All right. Take care, everybody. Take care. Cheers.
Thanks.